But I've been talking about the Federal Reserve obviously a lot, but I've been talking about specifically the Federal Reserve going broke, which sounds pretty crazy because the Federal Reserve literally prints money out of thin air, right? Like, don't they just create the money? So how do they go broke? I mean, only an incompetent government agency could do that, right? Well, yes and no. The Federal Reserve has gone broke because they have raised rates at the fastest rate in history. They've booked a $100 billion loss in just the last few months on their operations because they're having to pay out more interest to banks on reserve deposits at the Fed than the central bank earns from its portfolio of bonds and mortgage-backed securities. So just like any normal bank, they have income and expenses, and because they've changed their rates so much, they're now losing money on that. Unlike federal agencies that spend tax dollars allocated by Congress, the Fed is self-funding, right? It earns from its asset holdings and fees charged to banks for, the different types of services that it provides, and it used that to pay the roughly $6.3 billion in annual expenses that they have. They employ about 24,000 people in Washington and other cities across the country. What is that per person, Dan? 6.3 billion divided by 24,000 people. See if you can figure that out. But so basically, they have expenses just like anybody else, and now they're losing money. They lost $100 billion, and now they're having to lay off people. As a matter of fact, they had their first layoffs in 13 years. Now, what's interesting is they have, like I said, they have to start laying people off at a time when lots of people are getting laid off. But to see the Federal Reserve have to do this, to lay off 300 people from its payroll this year, it's a pretty big deal. Now, the headcount has been growing pretty steadily and pretty rapidly since 2010, so maybe it was time for a little bit of pruning, but a Fed spokesperson said that the cuts are focused more on the staff of the U.S. Central Bank's 12 regional reserve banks, and mainly hit the information technology jobs, including most of them that are just like no longer needed because now they have like cloud-based computer software and things like that. So they're saying it's really not a really big deal. These are jobs that we really didn't need anymore, and they're not really affecting us, so we're just trying to cut costs. But it doesn't change the fact that they're losing $100 billion. It comes out to $190,000 per person they'd be paying. Wow, it's a good job to be a banker. $190,000 average. I'm guessing obviously some people make a lot more than that and some people make a lot less than that. But what's interesting to know is that, the Fed typically generates a profit doing this. It always has. And what does it do with those profits? Well, the profits go to the government. It goes to the U.S. Treasury. But since the central bank has been losing money, then there's no money going to the Treasury. So what does the Treasury do? Well, the Treasury is losing money. Treasury is losing money from a lot of places. Tax receipts have completely plunged. So the Fed has been raising rates higher, so we haven't seen, prices of things, asset prices going up. So there's not a lot of capital gains being taken. Incomes have gone down. So tax receipts have plunged. So we have the Fed not giving them money. I think about $300 billion they lost that way. Tax receipts have plunged. So the Treasury is going broke. And this is a big, big sign of where things are going. Now, how did all this happen? Well, we can probably go back to the pandemic when the Fed lowered rates to the lowest rate in history, right? Basically to zero. In order to service the debt, then the Fed in less than a year purchased $4.7 trillion in additional assets, including $2.5 trillion in mortgage-backed securities. Central bankers invested this money in the form of long-term loans locked in at very low rates. But then they started to raise the rates. You've heard this story before. It's what happened in the banking crisis. And as they started to raise the rates, it caused them to have losses. In just the first 2 quarters of 2023, the Fed incurred a net loss of $53.5 billion on interest expense. Oh, no big deal. Just half the year, we lost $53 billion on interest expense. And this is only getting worse. The higher rates go, the longer rates stay higher, the more the credit markets stay tight or get tighter, the more they continue to lose. It's a big deal. It's a really, really, really big deal. On top of that, we see, like I said, the Treasury is also going broke. And the world's seeing this. The world's watching this, which is why we've been seeing the U.S. credit rating start getting cut. What happens when your credit rating starts getting cut? Well, when your credit rating starts getting cut, people don't want to extend you the same amount of credit. And that's exactly what's starting to happen. And now the Treasury is starting to have problems with people buying their Treasury notes or buying the debt. They don't want to buy it. And that's causing rates to go higher and higher and higher. But that's also causing a problem. It's only exaggerating the problem. But don't worry, they got a plan. They got a plan. So now it appears that the Treasury wants to start buying back the bonds. The resilience of the world's biggest bond market is a top priority as U.S. debt officials prepare to start buying back government debt, according to Josh Frosch, the Treasury Department's Assistant Secretary for Financial Markets. So they want to start buying it back. Why would they do that? Well, because the bonds have lost money, so they have to buy them back at a discount. So they're losing money. Frost said, our goal is to, quote, ensure that the Treasury market remains the deepest and most liquid market in the world, even if we have to pretend that it's working and we have to lose a lot of money to do that. He didn't say that. I added that. But the Treasury is expected in 2024 to start regularly purchasing its bonds for the first time in more than 2 decades, a move that comes after years of increasing scrutiny on Wall Street about the $25 trillion market's underlying fragility. Now, there's 2 different things they're really trying to do with this. All right? One, they want to help keep the liquidity in the pockets of the market and to help kind of smooth out the volatility of the bill issuance as it manages its cash balance, right? So they have to start buying these things back. They want to keep the liquidity going. They can't have some of these things go no bid. That would not work good. Frost said that the Treasury's liquidity-focused buybacks were not intended to address periods of acute market stress, a responsibility that falls under the Fed's mandate to ensure financial market stability. So the Fed has 2 mandates. 1, stable prices. They do that by trying to maintain a 2% pegged rate to inflation, 2% inflation. And 2, they're trying to keep stable prices and full employment and keep the financial markets stable, keep prices stable, keep the liquidity going. But if they don't continue to keep the liquidity going, then the whole system starts to fall apart. It's just too much stress on the system. In August, the Treasury announced the first increase in the sale of notes and bonds in over 2.5 years to address a growing fiscal deficit and the lack of support from the Fed as the central bank rolls debt off its balance sheet through quantitative tightening. So they've been trying to get rid of a lot of this debt, but that's a problem. It's tightening the system, but when they tighten the system, the liquidity goes away. The real story here is the Treasury is already shifting to quantitative easing while the Fed continues to pretend that it's tightening. And so this is where it's interesting. So what we're really seeing is a battle. We have the Fed, Jerome Powell, and the Federal Reserve sort of at odds and fighting against Janet Yellen at the U.S. Treasury. The U.S. Treasury wants to continue to spend money, continue to print money, but the Fed is trying to bring maybe a little bit of austerity back to the dollar to keep the dollar strong. You always hear that they don't want to give up control over money. Well, who doesn't want to give up control over money? The Fed doesn't want to lose control to the ECB or to the BOJ or to the PBOC. And so the Fed wants to rein in the spending. They want to keep the dollar strong. They don't want to lose control over money, but the Treasury is spending like a drunken sailor. And now the two are at odds with each other. It's an interesting dynamic to watch play out, but don't worry, I'll keep you up to date